Alright, so it's the 1st of May, the start of a new month, and time for monthly market analysis. But before that, a quick disclaimer. So let's start off with the S&P 500. It continues to be in this downtrend consolidation pattern. We had that break above the resistance in middle of March when it made that first low, and I thought, hey, okay, that's it, that's the low for the year, we're now going back up, and it did go back up, but then it hit resistance, couldn't break through, and came back down again. So we can't predict the market exactly, as you guys know. So we're down again, and now we have gone below that previous support, but still above that swing low in middle of March. So I won't be surprised that in the next few days, we will go lower and retest those lows and possibly exceed those lows. Usually a bottom forms when you've got a double bottom and the second bottom exceeds the low of the first bottom. So in other words, it goes below that low and then reverses back up. That could be a possibility. Another possibility could be it could test all the way down to 17%, which I did mention early this year, because I said that usually in US midterm election cycle, the market has been known to correct down to 17% on the S&P 500. So we'll see how that goes. But the S&P, well, technically it's not in a bear market yet, although it looks like almost every stock that we own is in a bear market. The Nasdaq's in a bear market, but the S&P is kind of like holding up pretty well because of energy and staples and utilities. So in a way, I agree with what some of you are saying, that this actually feels like a bear market. It's kind of like a stealth bear market where, again, a lot of the companies we own are down 20, 30, 40%, but the S&P doesn't show it's a bear market because it's being held up by certain parts of the market, like I said, the energy, the utilities, the consumer staples. But even though it's not a bear market, it might as well be a bear market because most of our stocks are down more than 20%, which I'll go into depth in the portfolio review. So year to date, the S&P is down 13%, all right? And the Nasdaq is in a bear market. So bear market means the market closes 20% below the high. And if you look at the Nasdaq, yep, we are down, back down below the March lows. So again, this could be a sign of a double bottom. You never know, right? It could double bottom. If it forms a strong bullish candle, we could reverse back up next week. We'll see how that goes. But bad news is that it's below the 20% peak, so Nasdaq's in a bear market. So Nasdaq's down 23%, S&P is down 13%. Now, my portfolio is down 27% year to date. This is a bigger drawdown than what I had in March 2020 during the COVID crash. During that crash, my portfolio was down 26%. Now it's down 27%. This is huge. Now, a lot of investors would feel upset or feel scared. Oh my God, what's happening? My portfolio's down like 27%. By the way, in terms of dollars, I'm down like 1.3 million from the top, okay? Now, I'm not upset. I'm not worried. I'm not fearful. In fact, I'm still pretty optimistic, pretty excited. It's not because I'm crazy. It's because I've been in the markets for 30 years. I've gone through so many bear markets. I've been through so many corrections. I went through 2000, 2008. I went through 2018. I went through the March 2020 crash. And after every bear market, after every crash, I always got richer eventually. Every time my portfolio dropped by 20%, you'll go up 50% or 100%. In fact, in March 2020, where my portfolio dropped 26% during the March 2020, it ended the year up kind of like about 48%. And then the following year, 2021, my portfolio was up another 46%. And then, so overall, after dropping 27%, my portfolio went up 100%, right? So this will be no different. Yeah, my portfolio may be down 27% right now, but by the end of this year, or maybe next year, or the year after that, it's going to be up like 50, 100%. I know that for certain because I'm invested in great companies that are undervalued and they will always go up. They always go up eventually. Maybe not now, maybe not next week, maybe not next month, but they will go up eventually. So my confidence comes in understanding the businesses that I own. Now, as usual, I'll go through all my stocks in detail in the portfolio review videos. Now, some critics would say, but Adam, if you're so smart, why are you down? If you're so smart, you could have seen the crash coming, you should have sold everything at the top and shorted the market at the top and bought commodities, and now you would not be down at all. You'll be like up every year, every day, every month. Well, it's because I don't have a crystal ball, dumbass, and no one has a crystal ball. So the reason why a lot of people fail in the markets is because they come in with unrealistic expectations, thinking that as a great investor, you can see the future. You know exactly where's the top, exactly where's the bottom. And that's why most people fail, because they come in with these naive expectations. Hey, even the greatest investor in the world, Warren Buffett, who's been investing for the last 80 years, his portfolio doesn't go up in a straight line. It goes down as well. In fact, he has seen his portfolio drop like up to 50% more than 4 to 5 times in his career. And there's only one guy on Wall Street whose investment portfolio never goes down. It goes up like every single year without fail, has never dropped at all. And his name is Bernie Madoff, who was found to be the greatest scammer and fraud on Wall Street because all his investments were all fake. It was a huge Ponzi scheme, and he was sent to jail for 100 years and he died in jail, right? So the point is this. The point is, if anyone tells you that they can see the future, they can sell at the top, they can buy at the bottom, it always goes up, it's a freaking fraud, okay? It just doesn't exist. So if you think that way, grow up. Hey, don't be so naive, all right? So like I said, I'm not fearful. I'm excited because I know that it's part of the journey. And it's kind of like marriage, right? You can't have a great marriage without arguing once in a while. And after every argument, that should strengthen your marriage. It's unrealistic to think that, I'm going to have a marriage for like 50 years, never argue, happy every single day. Yeah, try. Try that. Go ahead. Best of luck. It's the same thing with a business. In business, you can't always have sales. You gotta have sales and cost of goods sold, and that gives you profit. So I look at my portfolio the same way. My portfolio goes up, it's like sales, but I can have sales all the time. I gotta have some cost once in a while before the next sale. And remember that the market is kind of like a breathing pattern, right? Breathe out, breathe in, breathe out, breathe in. No matter how strong you are, you can't breathe out forever. It's impossible. You can't, right? You gotta breathe in once in a while before you can breathe out even further. So the market is designed in a way that you have to take one step back to take 3 steps forward. And sometimes you take 3 steps back like now, or 4 steps back to take 8 steps forward. So once you understand that that's how the market works, you don't get upset, you don't get concerned during these drawdowns. You expect it, you anticipate it, and you go with the process. You enjoy the process. And why not? I always say enjoy the journey. It's not just the destination, it is the journey. And I tell people that if you buy a portfolio of great companies, underlying good businesses, and you buy them at reasonably good prices, you don't have to buy at the bottom. As long as you buy them when they're undervalued, collectively, it is impossible to lose money. It is impossible to lose money because eventually they will go up again to new all-time highs, right? The only way you can lose money is if you sell halfway at bottom prices because of fear, because you panic halfway, and as long as you invest with money you don't need urgently, you don't invest with borrowed money, there's no one forcing you to sell. You just hold it through those ups and downs. So as I always like to say, the stock market is like a roller coaster. And the only people who get hurt on the roller coaster are those that jump off the ride halfway. If you stay in the ride and enjoy the roller coaster, you will reach the destination eventually. So let's take a closer look at what is under the hood of the S&P 500. Again, the index is down 13%. Not that much, but my portfolio is down 27%. And I would guess that for many of you, a lot of the companies that you hold are down more than 20%. So you may say, why? Why am I underperforming the market? Now, the reason I am underperforming the market so far this year, I've mentioned before, is because my portfolio is concentrated into technology companies, consumer discretionary, communications company, which so happens that now these are the ones that are down the most. These are the sectors that are down the most. If you take a look at year to date, you can see, ooh, communication services like Facebook, for example. Disney is down 24%. Right? Technology, like your Microsofts and your Viva and your Salesforce is down 23%. And consumer cyclical, which are consumer discretionary stocks like Nike and so on and so forth that I own, is down 22%. So my portfolio is concentrated in the three sectors that are getting bashed the most so far this year. And of course, I've got a bit of healthcare, I've got a bit of real estate, and a bit of industrials, which are also down 11%. So in my portfolio, I don't have any exposure to energy. I don't have any basic materials. Consumer defensive, I have a few, and I've got no utilities. So notice that these are the ones that are propping up the market, and that's why I'm underperforming, because I don't have these sectors. And I mentioned why I don't have these sectors is because in the long run, technology, communication services, and consumer cyclical, and healthcare and financials, in the long run, these sectors outperform the market because these are the sectors with the highest growth, with the highest profit margins, and with companies with the strongest economic moats. But in the short term, they're not doing well because the market sentiment is kind of like, going away from growth, away from innovation, and towards all these safe kind of sectors, right? So should I sell my stocks and buy these ones that are going up? That's what some people are doing, right? They sell the out of favor and buy the ones in favor, and like they want to catch that trend. So I don't want to do that because right now these sectors are pulling up the market, but they are overpriced, and in the long run, they don't perform. So I'm going to stick with the sectors I have and use this opportunity of a big drawdown to slowly keep buying shares into the company. Because I always say that this is a crisis, and never let a crisis go to waste. Use it as an opportunity so that when it turns around and markets normalize, you would really outperform the market again and make a lot of money. So I've got no doubt of that. And I'm sticking to the investment plan. That's the key. Always stick to your investment plan and don't change it halfway and go chase what looks nice and abandon what you have, right? There's a very old saying in hockey, ice hockey, by Wayne Gretzky, this hockey great. He said, don't skate to where the puck is right now. You know those puck which they hit with that stick, right? Don't skate to where the puck is right now. Skate to where you think the puck will go to in the next couple of seconds, right? So that's what we do in investing. Now, if you take a look at the S&P 500, look at the component companies, you can see that again, the majority of the great companies, the one with growth, the one with strong economics, they're the ones that are getting hit the hardest in this very strange market, right? So Amazon's down 25%, right? That's a big position I have. I've got Google, big position, down 20%. I've got Facebook down 50%. I've got Microsoft down 17%. But the other ones that are green, holding up the market, are the energy stocks, right? These are all green. These are all going up, but I don't own any of them because in the long run, energy companies have low profit margins, are unpredictable, and they underperform in the long run, right? So I don't touch any of those. And again, no regrets not going in a short term because I'm sticking to my plan, right? Healthcare, I've got a bit of healthcare. Should have bought more, but I've got a bit of it. So that's kind of like holding my portfolio up. But that is what's doing well so far this year. And I've got some of these financials as well. And of course, basic materials, commodities also pulling the market up. So if you're like me, and again, your portfolio is underperforming the market and you're wondering why am I down 20-30% when the market's only down 13%, you're not alone. All right, a lot of us are going through that, including me. But don't worry, when things turn around, it would flip the opposite and you will way outperform the market. Okay, now first the bad news and then the good news. Well, actually, there's no such thing as bad and good news. It's like what Master Wu Gui says in Kung Fu Panda. There's no good news, there's no bad news, there's just news. All right, so the bearish news, right? The bearish news is this. This year has been pretty historical because from January to the end of April, we have seen the worst 4 months, or not the worst, the third worst 4 months since 1932. Okay, so we can see that right now we are down 13% for the first 4 months of the year, and this is the third worst decline in the last 90 years. Okay, so it is a historic moment. So be proud that you are going through this, right? And you will get out of it stronger. Okay, so what was worse was 1932. It was down 28% for the first 82 trading days, January to April. 1939, it was worse as well. So we are the third worst. Then it was 1942, down 11%, 1970, and so on and so forth, right? Now, for the 2 years that were worse than what we're going through, what happened from May to the end of the year? So what happened in the next 3 quarters of the year was that the market gained 18%. Okay, so normally when you got a really bearish first half or first quarter, you tend to have a bullish second half. That tends to happen most of the time, right? So although 32 ended down, but it ended down 14%, not as bad as how it started, right? So 1939, again, the second part of the year was bullish and it kind of like paired a lot of those early losses, but it still ended down 5%, right? So this year, we're just finishing that first quarter of the year. And the second quarter, I'm pretty optimistic that we will be bullish in the second part of the year, right? And we may still end down, but chances are we won't end as down as where we started this year, all right? And of course, there are times when you end down the first quarter, but you could still end the year up by the end of the year. So you never know, right? Of course, you could get the entire year down as well. That's still possible. But you can see more often than not, the second part of the year tends to be up if the first half is down. Not all the time, but tendency. So that's the more bullish news. So I do expect we should have that bounce. Now, so what must happen for the market to change sentiment? So the main thing that's pulling the market down right now is this high inflation, right? Is this high inflation that's causing the Fed to be forced to raise interest rates very fast and to tighten their monetary policy, all right? And of course, this inflation is being exacerbated, being made worse because of the war and because of supply chain problems, because of China's COVID-0 policy. So for the sentiment to turn, what needs to happen? What needs to happen is we need to see inflation start to peak and come down. So for that to happen, what would help is if there's a kind of like a resolution to the war, number one. Number two, China begins to loosen its COVID-0 policy, so supply chains get moving again and supply is, more flexible, and that would bring down inflation. Number two. The third thing is inflation will also come down naturally as demand starts to drop, as prices get too high, people want to cut back on their spending, as mortgage rates go up, naturally demand will go down. So all these factors combined is what we need for the market to turn around. Now, this is from Larry Williams, who's a legendary trader who's probably been trading the markets longer than I've been alive in this world. He's I think 70 or 80 years old right now. Legendary trader. And what Larry does is he does a lot of forecasting of cycles. And one of the interesting forecasts that he did was of inflation. And you can see that inflation, like everything else, follows a cycle, right? So there's this cycle goes up and goes down and goes up and goes down. So this blue line represents the cycle, and this black line represents the actual inflation data. And you can see that going back to 1980, 30 plus years ago, it's pretty accurate, right? You can see the cycle, it goes up, right? Comes down, right? Goes up. I mean, it's not perfect, but you can see that cycle. You can see that cycle right here. And right now, where are we on inflation? We are right up there at about 8 inflation rate. And it looks like we are nearing the top of this cycle, that it should begin to turn down. Now, based on this cycle forecast, this should happen somewhere end June, early July. So in other words, latest end June, early July, when inflation peaks and begins to come down, that's when we may see sentiment begin to shift and the market go up really strongly. Now, it could happen before that, maybe in May, but it could be up to even June and July. And again, these other slides are from Larry Williams. I do suggest you watch his great video on YouTube. You can just type Larry Williams, and just credit these are his slides, not my slides, but I want to share it because I think it's really good. And you can see that whenever inflation peaked and came down, that was a great bottom in the markets, right? You can see over here, inflation peaked, came down, and market bottom, market started rallying, right? Inflation peak, came down, market bottom, rallied after that. Inflation peak, came down, market rallied after that. So you can see that pretty consistent pattern here, right? Again, inflation peak, came down, market rallied, market bottom and went up. Inflation peak, came down, market bottom and came up, and so forth. And again, where we right now, if you look at where we are currently, we are here, right? Inflation is really at a super all-time high, the highest in 40 years, right? So it's going to peak eventually, right? So once that peaks and it comes down, right, in the next 1 or 2 months, then the market would have a reason to turn around. So that's something that I'm looking at. I'm also looking at this bottom fishing indicator, this famous indicator which I pulled out during the March 2020 crash, and it worked then. Let's see if it works now. Okay. So again, for this to work, I'm looking at the S&P 500 on weekly candles, and there are two indicators. The first is the Williams percentage R 52-week close and the normalized ATR. So these are two indicators. Now, what makes it pretty powerful? If you look at history, every time this line, this Williams R, dropped below minus 80, can you see minus 80 is the oversold level, right? So here it dropped below minus 80. It dropped below minus 80 here, here, and here, right? So every time it went below minus 80, it tells you that the market is oversold, like a rubber band. It's overstretched, it's gonna snap back up. But you can't just look at this alone. You have to also look at normalized ATR. So the pattern we have found is that when normalized ATR goes above 80, which is this line over here, whenever this goes above 80 and this goes below minus 80 and they happen at the same time, they coincide, that tends to be a pretty good bottom in the markets, right? Coincide, bottom in the markets. 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 So right now, you can see that this has dropped below minus 80. And it's not easy to get below minus 80. This has happened 1, 2, 3, 4, 5. Only 5 times in the last 14 years. So it's not easy to get below that. So we are below that, right? But this normalized ATR went above 80, but is now back below 80. So this signal is not yet valid, right? So if this goes back above 80 and this stays below 80, that would be a very powerful bottoming signal. So I'm watching this closely to see when that would take place. All right, so again, I'm looking at many things. It's not just one thing. I'm looking at inflation. I'm looking at this to see, where could we see a bottom? But remember, as investors, we don't have to predict the exact bottom. We don't have to buy at the exact bottom. As long as we buy consistently when it's undervalued, and we average in our position, as long as it's somewhere near the bottom, it's fine. We will make a lot of money when it rebounds eventually. We don't have to catch the exact bottom. And I'm doing this more for entertainment purposes, right? But it's not critical to make money. We will make money regardless of whether we catch the bottom or not. The other thing is the fear and greed index. So right now, the fear and greed index is at 27, which is still at the fear stage. So if the market goes down a bit more in the next few days, we could go to extreme fear. And extreme fear is good because when the market gets really scared, people are shitting their pants. That tends to coincide with a market bottom, right? You can see here, oops, whenever we have got, again, extreme fear, which is about below 25, right? Below 25, extreme fear, market tends to find a bottom. 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 So right now, extreme fear, not yet, but akan datang, coming soon to a theater near you. Let's see how that goes. The other thing that I'm looking at is, of course, the VIX. The VIX is the volatility or the fear index. And you can see every time this sucker gets above 35, that means there's extreme fear. And again, that tends to coincide with a market bottom. All right. So right now you can see, it went all the way up here to 85. This was the COVID crash. Now, as of now, Friday, it touched 33. So like I said, if it goes above 35 this coming week, we got really high VIX that could signal a bounce in the market. All right, so watching all these things very carefully. Now, some people have asked me whether is it possible that this S&P goes into a bear market. We've got a really bad recession, and this bear market is as bad as 2008 or the year 2000, where the bear market lasted for like 2 years, and we go down for 2 years, and we take another 3 years to go up. Is that possible? Well, everything is possible, but I still don't see that happening. I don't see a protracted recession or bear market like in 2008 or the year 2000, because some people are saying, hey, what if this is actually the beginning of this long crash? So why don't I see that? Because remember that in 2008, 2009, there was a lot of systemic risk in the market where the banks almost went bankrupt. They were holding all these assets that went to zero, these mortgage-backed securities. Millions of people lost their jobs. All right, we don't have that here. We have got unemployment at a historic low. We have got wages going up. People are employed. It's a bit different. Banks are well capitalized. Consumer balance sheets are strong. We don't have that systemic risk. Or during the dot-com crash, when many of the tech stocks at that time were not making money. But if you look at the companies that are dropped so much, like Amazon and Facebook, or even Tesla, or even Microsoft, they are making money. They are making a lot of money. So it's a very different situation. Of course, we could have systemic risk if freaking Putin goes nuclear, right? I mean, if there's World War III and nuclear, I mean, sure, that could really create systemic risk. But unless that happens, right now, there's no major systemic risk in the markets. Now, some people say, but Adam, we just had an announcement that GDP came in negative. And everyone was shocked that GDP was negative. And as you know, a recession is defined as 2 quarters of negative GDP growth. And we just had the first quarter where GDP for the first quarter of this year fell 1.4%. So does this mean that we're halfway into a recession? Maybe we could have a technical recession. A technical recession is a recession where it's very short and sharp, right? And even if we do get a bear market, it'll be one that's a pretty fast bear market, not like a protracted 08, 09, 2000. Now, if you actually break down this first quarter GDP decline, there's some silver lining behind it. Here's a silver lining. Normally, one of the biggest contributions to GDP growth in the US is consumer spending. That's the most important part of GDP. And the good thing is that consumer spending was actually up, although lower than expected, but consumer spending still rose 2.7%. Business spending also rose 9.2%. So the only thing that caused GDP to drop the first quarter was trade. Now, trade was a negative 191.6. Now, this is a technical reason why this happened right now. Understand how they calculate this. When the US imports things, it's a negative. It's a negative to trade. When they export, it's a positive. All right. So in quarter one, there was more imports than exports. So there was this trade deficit that causes negative. Now, why did this happen? Reason is because in November and December last year, there were a lot of imports that were supposed to come in, but the ships were stuck along the coast of California. You know, they couldn't dock because of COVID restrictions and all those things. But now that the ships can come in and they're unloading these imports and they record the imports in Q1 this year, that's causing a surge of imports in Q1, hence causing the trade deficit, causing trade to deduct 3.2% from GDP, right? And the second reason is because of inventories. There's a drop of inventories of 0.84% to GDP. Reason is because initially there was a lack of inventory, and then what businesses did last year was they build up their inventory stock, and now that their stocks are full, they got enough inventory to meet demand. They don't need to build inventory anymore. So inventories are kind of like declining, right? And that's why you've got that negative spin to GDP. So in other words, the GDP number is not as bad as it looks if you actually go below the surface of why that has happened. Now, interestingly, the last 2 or 3 days, everything came down, right? Bonds went down, the US, where every bloody thing went down, crypto went down, something that I don't touch, but everything went down. The only thing that went up was China. So I'm not surprised that this year China could actually be the best performing market in the world. Maybe, I don't know, right? So some good news for those of you holding Chinese equities, like me. I have got a 12% allocation right now. China now is saying, okay, they are going to end their regulatory crackdown over the technology companies, and they are now telling the big tech companies, okay, we're not gonna screw you anymore. We're gonna let you grow, and we need your help to grow the Chinese economy, because right now it's in a sluggish position, and the Chinese government is now kind of like doing their best to stimulate the economy, spending on infrastructure spending, and because of that, hallelujah, Chinese stocks had a huge rally in the last few days. So Alibaba went up, Tencent, Meituan went up, 12 to 15%. So some people are skeptical that can it sustain? I think it could. And I think that the lows of the China markets are in. I don't think we're going lower anymore. I think it's a matter of consolidating. And from here, there's going to be a lot of upside for Chinese equities. So this has been our monthly market review and analysis. And I'll see you guys in the portfolio review videos where we go through in detail all the stocks in my portfolio, the revised intrinsic values, and the revised buy points of where we can continue to build our positions in good companies. I'll see you in the next video.